Hey everyone and welcome. I'm Sumit Roy, Senior Analyst here at ETF.com. We got a great show for you today. Our guest is Kevin Flanagan, Head of Fixed Income Strategy at WisdomTree. Thanks for joining us, Kevin.
Great to be here. Happy New Year.
Happy New Year to you as well, Kevin. And I want to start with the Fed because this was a big story in 2022. Going into 2022, the Fed was behind the curve, right? They underestimated how high and how persistent inflation would be. Now, are they doing the opposite? Are they overly tight?
Fascinating point of view on this because, if you look at the way the Treasury market has been responding of late, they don't seem to be buying what the Fed's selling, right? I think the Fed is trying to get the message across that they're going to continue to raise rates and then hold them there for a while, that there is no thought whatsoever at this stage of the game that the Fed would consider loosening monetary policy. Matter of fact, you always see the words, it would be premature to consider such a thing, or it could be a policy error. But we all know, if we go back 12 months ago, to your point and how you phrased the question, how quickly things changed and how the Fed pivoted from essentially being a rate hike or two for next year to the next thing you know, you're over 400 basis points higher in the Fed funds rate.
Absolutely. Things change so fast. Are you buying into the Fed's narrative that it's going to be able to hold interest rates at 5% throughout 2023?
Great question. So, when I was brought up and coming up on the trading floor, we were always taught two things: don't fight the Fed, don't fight the tape. And now the two of them are kind of going up against each other and clashing. At this stage of the game, I'm going to take for now. Second half of the year could be a little bit different, but for now, I'm going to say don't fight the Fed. I do think they want to take us to a 5% terminal rate on Fed funds. So it's a question of, 25, 50 basis points. I don't think we should get caught up in that. And I think the Fed is trying to make that loud and clear as well, that even if they were to reduce their pace of rate hikes from the 75 to 50 and then 50 to 25, does that mean that they're coming to an end? No, not necessarily. It's just that we're in a different phase of the rate hike cycle. So let's just use 5% as kind of our baseline where we think Fed funds is going. Could it even be a little bit higher? Yes. Could it be lower? Don't think so. So I think that's also, an important point to make as well. And I would tend to argue that the Fed will pivot. To me, the Fed pivot is from rate hikes to rate cuts, not rate hikes to stopping. So I think that they could be on pause longer than what the markets are anticipating at this stage of the game. Is it for the entire calendar year? Maybe that's a little bit too long, but sometime in the fourth quarter, maybe December, I think that's a more likely time frame for when the Fed may be starting to think about a rate cut.
Absolutely. And then those big Fed rate hikes, along with high inflation, prompted the US bond market broadly to essentially have its worst year in modern history. Do you think the bond market is going to have a better year here in 2023?
For sure. Your point well taken. Perhaps one of the worst, if not the worst, performances on record for bonds as measured by the ag per se. But what I think that has done is set the stage for fixed income in 2023. We're now seeing interest rates that a whole generation of investors and advisors have never witnessed before. You have to go back to 2007 essentially to see yield levels at where they are currently. And I think what brings to mind with that is a return to normalcy for fixed income, where rates are now are normal, where rates have been the last 5, 10, maybe even 15 years or so is not normal. 0%, 1%, barely 2%. That is not a normal fixed income setting when you're looking at overall yield levels. So what I like to say is income is back for fixed income. And that, I can see right now core fixed income continuing to see attractive flows. High yield strategies as well, I think, will be another area investors should be considering. And of course, Treasury floating rate note strategies. I mean, with the Fed raising rates and keeping them there for a while, you're essentially dealing with elevated yield levels with no duration. So to me, those would be the three areas of fixed income that I would be focusing on for next year. Or not next year, this year.
Yeah, got to get used to 2023 here.
Right.
You touched on those three areas, and it is interesting because we are seeing the deepest inversion in the yield curve in a really long time, and you're not really benefiting from duration in this market environment. You're getting lower yields, you have higher interest rate risk. So do you recommend that investors avoid duration today?
You're right. You're essentially not getting paid to move too far out on the curve. Now, that doesn't mean fixed income isn't the place to be. That's where I think that core kind of benchmark is something to look at with respect to duration, which is usually somewhere around 6 to 6.5 years overall in duration. But once you get beyond that, it really is the law of diminishing returns, if not the law of perhaps some vulnerability going forward. If you look at it as we're speaking here, Summit, a 10-year treasury yield at a little bit over 3.5%, you have to ask yourself a question that if you are in fact moving into that kind of a duration instrument, you're then pretty much telling yourself that yields are going to fall to 3%, 2.5%, somewhere around that level, if you're to make that kind of a commitment. So I think you can essentially get that yield capture that we're talking about in fixed income without having to go that far out on the curve. I think looking at things, as I mentioned, core, 6 to 6.5 years, high yield tends to be a little bit over 4 years. Treasury floating rate strategies, 1 week. Those would be the three areas I think you can blend in a bond portfolio.
And finally, Kevin, you touched on high yield, but I want to ask you to talk about the credit markets a little bit more. And my question is, have we priced in a recession when it comes to the high yield and investment grade bond markets?
What I find interesting is given where I think spreads are, and given thoughts about default rates, you have to, I think, come to some conclusion that there has been a discounting mechanism for a recession, right? I mean, this has to be the most widely expected recession I can remember in my 30-year career. So if you look at spread levels, you would tend to think, well, that's probably factored in already. And then if you were to look at the fact that, Moody's talked about increasing default rates for this year, maybe tripling from where they were, I think around 1.5%. I'm not the only person that's reading those reports as well, right? So you would tend to think logically, or a reasonable case scenario would be that high yield credit here in the US has allowed for a recession of a more mild magnitude. Now, if the economy falls off the cliff, that's a whole different scenario, but I don't think that is what the markets are expecting either, and certainly not what's priced in, and not our base case either. So, a mild recession, higher default rates, in our opinion, would seem to be kind of baked in, I think, at current yield and spread levels. And not to mention, one more thing on that front is that you're now dealing with far more of a cushion in high yields than where we were 12 months ago as well, right? I mean, high yields are now up, if I'm not mistaken, a couple hundred basis points from where you were last year. So in a sense, that cushion that if you do see some widening in spreads is far more available to an investor and a lot less, I would say, vulnerability than 12 months ago.
Well, Kevin, a ton of great information. Thanks so much for joining us and sharing your insights.
Always a pleasure.